Good morning, good afternoon, and good evening, everybody. Welcome to this webinar of the Liechtenstein Initiative for Finance Against Slavery and Trafficking, Modern Slavery, Investment Risks and Opportunities. It's my great pleasure to welcome all of you. My name is Dr. James Cockayne. I'm the Head of Secretariat for the FAST Initiative, and I'm delighted to be joined by a wonderful panel of experts this morning and this afternoon, depending on where you all are. You can see them here on your screen, and we'll shortly be joined by all of these fantastic speakers to share their views on how modern slavery risks factor into the current investment landscape, where it poses risks for investors and where in fact there may be opportunities for investors to take advantage of those risks to people, or of efforts, I should say, to address those risks to people with a commercial upside. I should point out right from the top that we are recording this session. It will be available shortly after the event for you to watch or disseminate to your colleagues. And I'd invite you, as soon as you're ready, to start posting questions in the Q&A session. We're looking forward very much to an interactive Q&A period at the end of the event for a solid 20 or 30 minutes. And the more questions we get from the audience, the more piercing your questions, the more lively and interactive that exchange will no doubt be. So before I introduce our panelists, I'm just going to take a few minutes to introduce you to the FAST Initiative and to situate you in the landscape here of how we understand the relationship between modern slavery risks and investment opportunities. So next slide, please, James. The Liechtenstein Initiative is a multi-sector partnership that was established several years ago with the support of the Liechtenstein government, as well as the governments of Australia and the Netherlands, and Liechtenstein private sector donors and supporters, to consider how we can mobilize the financial sector to address modern slavery and human trafficking risks. Now, what do we mean when we refer to modern slavery and human trafficking risks? Next slide, please, James. There are 40.3 million people around the world, according to the International Labour Organization, thought to have been in a situation of enslavement or forced labor in 2016, the most recent year for which we have global estimates. When we say to be in that situation, what we're fundamentally getting at is that one person is essentially being treated as if they were owned by another. That fact pattern may be described in a number of different ways in different criminal and civil law jurisdictions. But the fundamental fact is that it is illegal at all times and in all places under international law. And that fact pattern tends to give rise to what in the financial sector are often known as predicate offenses. So offenses that lead to other financial reporting, monitoring, and risk management obligations, particularly germane or relevant for the banking sector, but also increasingly in the context of compliance and disclosure rules, relevant also for institutional and sovereign investors. As you see on the screen here, the unfortunate fact is that modern slavery is present pretty much all around the world and in a great variety of sectors. On the left-hand side, you see the estimated distribution of cases by sector. But that particular distribution can vary very significantly at the national or even local level. So we often say to people we're talking to about modern slavery risk that a national or regional level assessment isn't going to get you very far, especially if you're an investor. You want to be looking at risk certainly at the supply or value chain level, and where possible below that, down to the firm or even the worksite level. And some of the people we're going to hear from on this expert panel will be talking about some of the challenges involved there, but also how we can learn from other efforts in the financial sector to address social externalities and other externalities to begin to grapple with these kinds of problems. Next slide. Now, I mentioned externalities, and this is an important way that we approach this issue at the Liechtenstein Initiative. Slavery is a market failure. it is essentially a failure to price in the true social impacts of coercion in the workplace. So at one level, you could say it's a bit like the problem we faced with pricing in carbon emissions and other environmental impacts in previous years. But of course, modern slavery is different than carbon emissions. Carbon emissions are an objective fact. Once they're out in the world, they can be measured. Modern slavery is something involving a relationship between two or more human beings, and it's quite often deliberately hidden from view. So the simple act of measuring it is in some ways more complicated than it is to measure carbon emissions. And several of our speakers this evening are going to pick up on that idea and talk about what we can and can't learn from the financial sector's efforts to deal with climate risk and the complexities of measuring modern slavery risk and what that means for investors. Next slide, please. A quick look at the Financial Sector Commission that was created by the Liechtenstein Initiative a couple of years ago. On the left-hand side, you see the conveners, starting with the Prime Minister of Liechtenstein, the Foreign Minister of Australia, then Professor Muhammad Yunus, the Nobel laureate and microfinance pioneer, Foreign Minister Stef Blok of the Netherlands, and our illustrious chair, Fiona Reynolds, Chief Executive Officer of the UN-backed Principles for Responsible Investment. On the right-hand side, the 25 wonderful experts from all different walks of life, from hedge funds and anti-money laundering regulators through to anti-slavery activists and to incredible survivors of modern slavery, each of whom, after exiting exploitation, had managed to work with the financial sector in one way or another and to work on addressing these issues. Real champions and survivors, and a wonderful source of expertise for us on the Commission. We believe at the initiative that learning from survivors is a key way that the financial sector can improve its ability to understand, identify, and manage these risks. And we try to practice that in our own work at every level and in all of our engagements with the sector. Next slide, please. The Commission produced a blueprint that was published a year ago, and the key framework in the blueprint is this particular table. It's probably too small for you to read it there, but please visit our website, fastinitiative.org, and take a look. The table sets out the 5 FAST goals, the 5 goals that any financial sector actor can pick up and begin integrating into their own business relationships to begin to address these problems. Those of you who know the ESG and business and human rights space will see a lot of overlap with some of the ideas coming out of the UN Guiding Principles and the OECD guidelines for multinational enterprises, both increasingly recognized as the authoritative frameworks for understanding expectations on business, including investors, to identify and address human rights risks and harms. And modern slavery is, of course, a special case of a particular human rights harm. So for those of you who are already taking steps to address human rights risk in your own investment portfolios and practices, we first of all applaud that and welcome that very much. And secondly, would say that modern slavery is an area where you might want to pay particular attention, not only because of the inherent significance and gravity of this risk, but also because when a financial institution becomes associated in the mind of the public or the regulator with that particular human rights risk, the consequences can be quite severe. We have an interesting recent case in Australia where one of our 4 largest banks was subject to the largest corporate fine in Australian history as the result of a very large number of anti-money laundering violations, a very small number of which were connected to online sexual exploitation of children and the use of this bank's payment systems, unfortunately, to pay for that exploitation offshore. But it was that particular phenomenon, the connection to online child exploitation and child trafficking, that stuck in the minds of the public and the media and led to particularly strong reaction from markets and from regulators. That bank lost 14% of its share price in a few days. It lost its CEO, it lost the chair of its board. So this is a signal, I think, that the the compliance pressures, the market pressures around this particular form of social risk, modern slavery, are likely to be strong and likely to be important test cases for any of you thinking about taking social impact seriously in your own businesses and business relationships. Next slide, please. The commission that created that framework was very keen to make sure that the market has the tools it needs to begin to implement it. So here you see just a selection of the different tools that we've made available through the Liechtenstein Initiative, everything from a risk mapping tool to an initiative to engage directly with survivors, which is really targeted at banks. On the next slide, we'll briefly see a demonstration of the risk mapping tool. This is a tool you can visit on our website, fastinitiative.org. It asks you a series of questions to begin to help you understand where the most salient modern slavery risks may be in your business, may be in your portfolio. It's not going to give you a granular risk map, but it is going to help you begin to think about how to prioritize your scarce time, your scarce resources, to begin to do the deeper dives into the most risky areas of your portfolio and work. Next slide. For those of you interested in more training, we offer a free online training certificate through the Association of Certified Anti-Money Laundering Specialists. You can visit this website or just take a screenshot quickly of that QR code and maybe go and visit that later. Did I mention it's free? It's been available for a few months and already over 5,000 people have taken this course from more than 130 countries. So we're very excited about that, and in particular to see how many of the people taking the course hail from the regions where the risk of these types of harms is highest, in particular Asia Pacific and Africa. Next slide, please. Now, enough from me. We're going to come to this fabulous panel now, and you're going to hear from them a number of different perspectives on the roles that investors can play in helping us all to tackle these challenges. You're going to hear about engagement and leverage, the role that investors can play in identifying and addressing these risks, and a fabulous new initiative that Shalini Samuel, who'll speak to you shortly, has helped to spearhead and stand up in Asia Pacific, just launched yesterday, depending on which time zone you're in. We're going to hear about incentive structures. How do we build the right incentive structures to get the market to integrate these risks into its decision-making? What can we learn from the shift by capital markets to address climate risks, for example? And we're really pleased to be joined by Dr. Lars Kaiser, an expert in these issues, who will be speaking to us on that a little later. Professor Joanne Bauer is going to talk to us about metrics and how we measure progress and how we can make sure that we're actually talking a common language when it comes to these risks in a way that allows us to compare progress across different firms and to begin to understand systemic impacts. And finally, on the panel, though not finally for the introductions, we'll hear from Prabhu Tirupathy, who is building a wonderful new instrument in India that is a good example of how we can look at risk management, not just as a defensive strategy, managing the downside, but an opportunity by engaging to reduce risk as a commercial opportunity. However, first of all, I'm very delighted to be joined here on the panel by Eric Nyman, who hails from, well, he's sitting, I think I should say, in Geneva. I'm not sure that's where you hail from, Eric. Welcome. Eric is the Corporate Alliances Manager at UNICEF, and he's going to help orient us to think about a particular part of this puzzle, the particular problems are associated with engagement on questions of child labor. Eric, welcome. The floor is yours.
Thanks, James. So I sit with UNICEF's Children's Rights and Business unit here in Geneva, but I am originally from Sweden. And I'm going to be talking a little bit about child labor here. I think this is the most maybe not well understood, but it's the most noticed aspect of child rights and business. But there are many more, and I think I should just mention this, that if you're interested in learning more about this, you can have a look at the Children's Rights and Business Principles developed by UNICEF, Global Compact, and Save the Children, and associated tools. There is a tool for investors on how to consider child rights in your investments, etc. But focusing in on child labor, and next slide, please. I think there is a value to unpacking child labor, because it is sometimes quite misunderstood. First of all, child labor is regulated in ILO Conventions 138, which is on minimum ages, and 182, which is on worst forms of child labor, as well as the Convention on the Rights of the Child, Article 32, which is the most widely ratified human rights instrument in the world. And basically, what Convention 138 says is child labor is work that harms the children's physical, mental, or moral health, safety, or morals. So basically, what it comes down to is work that is inherently harmful of children, work that robs children of their childhood. Now, the ages are linked very closely to the ages of statutory education, so minimum education ages, which means that countries have a little bit of liberty of setting these, but typically the minimum age of work is between 15 and 16. And this is usually where the definition stops. But what we see is there are obviously other types of work that can harm children. I should have mentioned a child is anyone under the age of 18. And this is where we come into this worst forms of child labor convention. It talks about specific types of work that no child can do, even if they're over the legal minimum age of employment. And these are things that have to do with slavery-like conditions, trafficking, service in the armed forces, sexual exploitation, and things like this, but also other types of work that are inherently harmful to children, such as working with chemicals, working in security, working in certain types of jobs that are often found in agriculture, working night shifts, etc. This is where a lot of companies, especially in the sort of lower end of the supply chain, get it wrong. Child labor is not a small phenomenon. It's 1 in 10 children globally are engaged in child labor, and this becomes a lot higher when we talk about Africa or Asia. But just to mention that this is a real problem, and it's certainly one that touches upon a lot of business activities. And although business is quite aware of child labor, it may not have the most effective interventions. And maybe moving on to that, next slide, please. So why do we have child labor? The first thing you need to remember is that children work because they don't have an alternative. This is very much driven by poverty, and this is something we need to recall, that if you want to address child labor, you are probably going to have to deal with other causes, like poverty, like social norms. In some cultures, you have social norms around child work. Lack of decent work opportunities for adults and adolescents. You may see child labor in cases where parents can't work. And I'll get a bit to that, what that looks like. Migration is a big driver, as is emergencies. We tend to see higher instances of child labor in those populations. And just to mention that, so what you may not see here immediately are things like where business controls, where the impacts are caused by business. So for example, you would have things like industries that have a high rate of spikes and lows in production and unpredictability of production. So that parents would be laid off and rehired, or furloughed and rehired. That would usually create a lot of stress on the families, and they don't have a protection net to deal with that, so children would go out of work. And similar things like certain kind of business models where you promote homework, where so parents can take some products home and finish them at home, typical in manufacturing, as well as contracts for service. So you would have, for example, in palm oil, it's a relatively common practice to have workers take on a plot of land where they manage the whole production. And that's where we typically see their children being involved in child labor as well. COVID has, there are initial signs that COVID has exacerbated these. A lot of this has to do with the fact that parents lose their jobs and the weak social protection. We also have the element of school closures, and that's an important thing to remember with COVID is a lot of the risks around COVID that don't have to do with the disease are around gains that have been made, but that are now scaling back. So it might have taken a lot to get certain children into school. When they leave school, they might go back into child labor. Next slide, please. So getting to the meat of this, what can investors do here? And I think my first advice to you is you've got to focus on the risk to children over the risk to business here. It actually is essential to do that to be able to also address the risk to business. The case with a lot of these issues that deal with children, with gender norms, etc., require you to get to root causes to be able to make a dent in the problem. There might be an overt manifestation of the problem, but if you don't engage with the root causes, the children will still work. They may not just work for you. So to eradicate child labor, you need to engage with these root causes. And this means basically a move from an audit or a compliance approach to a prevention approach. So it's not enough to look at instances of child labor in the companies you invest in, for example. It's probably not even that productive in terms of addressing the problem of child labor or having real impact on children's lives. It just means that children will have a harder time working in the businesses that you invest in. But those children will have to work no matter what. As I said before, children work because they lack alternatives. Now, this might seem like a really big task to put on investors to engage with things like social norms, poverty, things that are very entrenched in the countries that where child labor is prevalent. And it is. And I think investors trying to do this alone will not get very far. This is about, I saw the point of leveraging influence. And this is really what this is about. This is about leveraging the investor's influence on the companies that it invests in, but also in the industries it engages with. For example, I'll give you data. We saw in the 1990s in the economic crisis, a correlation between the price of cocoa and child labor in Cote d'Ivoire. The price of cocoa dropped 10%. We see a 3% reduction in school enrollment rates and a 5% increase in child labor as a result of that. Those are things that investors can probably engage with, especially investors as a group in a coalition, but also engage with the government, engage with the development assistance framework, etc. These are very entrenched problems and they need a multi-stakeholder approach to solve. Next slide, please. All right, I think that's it for me. Thank you very much.
Eric, thanks so much. That was a wonderful introduction to both the specific issue of child labor and then how this situates us for a broader discussion of the role of investors in tackling these problems. As you say, it may seem a little daunting to think about moving to a proactive engagement footing. But I think, you know, your point there about COVID is very immediate and relevant one, that there's a growing recognition we see across capital markets and the financial sector more broadly, that you're not going to profit from a supply chain that collapses. So questions of resilience and broader community well-being have risen rapidly to the fore. We've seen a big influx of capital into ESG investing and predictions just in the last few days, for example, from PwC, that there will be a 28.8 compound increase year on year between 2019 and 2025 in ESG assets under management in Europe, for example. So big move of capital in this direction. And it's no accident, I think, that it's institutional investors with their long-term horizon who may perhaps be most ready to take some of these steps towards engagement that you've identified, Eric. So on that note, it gives me huge pleasure to introduce a colleague, Shalini Samuel, who works with us at FAST, who's been central to an initiative that we're very proud to have been part of, an investor-led initiative that has just launched in Asia Pacific But without saying any more, I'm happy to turn over you, Shalini, to tell everybody about it.
Thank you very much, James. It's been a real pleasure to be involved in this initiative, and I actually can't wait to tell everyone about what it's all about. But before I begin, just by way of introduction, so my role sits as a partnership between Walk Free and FAST. And Walk Free is a global human rights organization that focuses on ending all forms of modern slavery, probably most well known for its flagship product, the Global Slavery Index, which produces country by country analysis of aspects of modern slavery, such as its prevalence, government responses, and good practices globally. So it works to end modern slavery by collaborating and engaging with businesses, financial sector, faith networks, and government actors. And on the business side, we really recognize the influence of the financial sector actors as a critical part of the global economy and the leverage that institutional investors have, which you've heard about already, to engage with companies that they own to address modern slavery exposures, both within their operations as well as their supply chains. So that's really where the partnership with FAST actually sits, to implement the FAST blueprint within the Asia Pacific region specifically by working with the financial sector in the region to eradicate modern slavery and human trafficking. So that's just a little bit of an outline of the role, but just to briefly set the scene for this initiative, if I can get you to go to the next slide, James. Regulators and markets across, the Asia Pacific are paying growing attention to modern slavery risks as part of this broader shift to take investors' exposure to environmental, social, and governance risks more seriously, as James had talked about earlier. And in Australia, the entry into force specifically of the Modern Slavery Act in 2019 is a bit of a game changer in encouraging both companies as well as investors to address modern slavery risks in their own operations and business relationships. So over 3,000 entities are in fact captured within the requirements of the Act, and they have to report annually. And the Act and corresponding guidance explicitly aligns the expectations of these entities with the UN Guiding Principles on Business and Human Rights. So couple that with an increasing number of stewardship codes and stock exchange listing rules and guidance in the region, it's almost like the region is calling us to come in and act on these issues. So essentially, both compliance and market pressures are at work in encouraging companies in the region to create some real change. And so Investors Against Slavery and Trafficking Asia Pacific, or ISAPAC for short, aims to kind of really turbo boost these efforts, because to create real change, companies will need to go further than complying with basic legal requirements and actually learn how to best find, fix, and prevent these risks. If I could take us to the next slide, James. So ISAPAC is an alliance of Asia-Pacific investors working together to engage with their investee companies to do this, to create real change. So it's based on the Find It, Fix It, Prevent It project being run by CCLA in the UK. So while CCLA itself is not running this project in the Asia-Pacific region, it's providing support, and the two projects really aim to kind of learn from each other and any similar projects that may emerge in other markets. So what does Find It, Fix It, Prevent It mean? So finding it is really about identifying and proactively searching the particularly risky parts of a company's value chain. And then in terms of fixing it, that's really about working towards fixing the issue, but also effective remedy for those affected as part of fixing it. And then preventing it refers to really working to ensure that the situation doesn't continue. And because most Australian companies are actually yet to report under the Australian Modern Slavery Act, ISAPAC believes there's this crucial window of opportunity at the moment to set out expectations for these reporting entities. So this is an investor-led project, which is a real delight for us, I think, because the fact that it's investor-led, it's kind of organically grown to where it's at now. And it's open to asset owners and asset managers in the Asia-Pacific region specifically to join. And can I get the next slide, James? So the aims of the initiative are to protect people from modern slavery, forced labor, and human trafficking, and where those things occur, help to remedy them, as I mentioned, to raise concerns about modern slavery risk with companies systematically and consistently. And in doing so, they anticipate creating more meaningful change through collaboration than by engaging individually, which we've heard about as well from both our speakers. And then to increase awareness of modern slavery risk among the broader investor and business community, The great thing about these sorts of collaborative initiatives is that you can avoid duplication of effort among investors working to address these risks. And then the initiative also aims to provide a framework for investors to address these risks in order to meet their own legal and other requirements. And then finally, to share information and knowledge about modern slavery risks. So IST APAC sees the potential of this initiative as actually something that might be able to set an example globally. Next slide, please. So there are two work streams within the initiative. The first is focused on reporting requirements for Australian companies under the Act. And the second is on company engagement with companies based in the Asia Pacific region more broadly. So the first work stream kicked off yesterday, as James mentioned, it launched yesterday. And that was with an investor letter from 24 signatories representing 5.8 trillion Australian dollars in funds under management, basically setting out these expectations that go beyond compliance with the Australian Modern Slavery Act. And the letter went out to the top 100 Australian stock exchange listed companies yesterday. And now we're getting ready essentially for the second work stream. And that second work stream is a collaborative engagement with APAC companies. And this will be based on CCLA's Find It, Fix It, Prevent It guidelines and expectations, but adapted to the Asia Pacific region. And it will likely focus on more than one sector, even though there'll be some sector focus areas that we will look at. And similar to Climate Action 100+ in some ways, for those of you who are familiar with that initiative, investors in this in doing these collaborative engagements will sign on as either a lead investor or a support investor. Regardless of their role, both will play an active role in the engagement process. And that work stream is planned to begin in January of 2021 and be a multi-year initiative. So it's at this point in time, it's great to see the momentum that the investors have. It's extremely action-oriented, which is fantastic. The next slide, please, James. So finally, I wanted to show you who these investors actually are. So First Sentier Investors has convened the group, and the founding members who also represent the steering committee are Aware Super, Australian Super, Ausbil Investment Management, the Australian Council of Superannuation Investors, and Fidelity International based out of Singapore. So Walk Free and Fast, together through the role that I'm playing on the initiative, are providing the secretariat, and we'll act as a knowledge partner as well. So gathering civil society networks, bringing timely location, sector, or thematic research to the group, so its activities really have a robust evidence base and the investors aren't actually just flying in the dark. So that's essentially the initiative in a nutshell. Thank you.
Great, Shalini. Wonderful news of this action led by investors. So just to make sure we didn't bury the lead there, you said yesterday 24 institutional investors, and what was their total assets under management?
It was 5.8 trillion Australian dollars, which is 4.2 trillion US. Yeah.
Great. And do you think that's going to grow, or is that where we're capping out?
Oh, no. I think it's going to grow. It's already grown just in the last day. We've had a new investor sign on, pleasingly, and we've got another couple that are in the works. I'm actually having a conversation with another global investor tomorrow who has an office in the Asia Pacific region. So no, it's very much going to continue, and there's a lot of excitement and energy around it, which is, yeah, really pleasing.
And am I right to say that URL there on the right, if our viewers go to that URL, they'll see a full list of the investors?
Yes, that's correct. So that's the website for the initiative, and everything that I've talked about today, as well as any additional information, as well as a contact form, is all there.
Great. Thanks so much, Shalini.
No worries. James, you're on mute. Apologies.
Thank you so much, Shalini. Not sure how that happened. Sorry, everybody. As Shalini was saying, this is a cousin, this initiative, to something that sprung up in the UK, another country where there's a Modern Slavery Act drawing the attention of business and investors to these particular risks. But with other compliance pressures emerging, for example, in Europe, growing attention to mandatory human rights due diligence, growing attention to non-financial disclosures, possible discussion of mandatory human rights due diligence at the European-wide level, there's every chance that we might see a similar convergence of forces in places like Europe. And we'd be thrilled to see investors in those places also getting in the mix. Other jurisdictions, such as the US, perhaps we should hold that for Q&A. So maybe I'll throw that to the panel to think about for Q&A. What are the chances, given, for example, that the Department of Labor is not so keen on retirement trustees and fiduciaries looking at ESG factors? Are we going to see those institutional investors moving in that direction? And if they don't, is this an opportunity, a commercial opportunity for investors elsewhere to get ahead of the curve on some of these issues? So maybe we can come back to that a little later. But right now, I think I wanted to pick up on another thread from Shalini, which was mentioning that some of this is modeled on some projects that have occurred in the climate space, another area where the financial sector investors in particular have been having to learn how to factor in externalities into their capital costs, their business decisions. And I'm really pleased that we're joined today by Lars Kaiser, who has particular expertise in this area and is going to talk to us today about the lessons that we can learn from climate investment actions to transfer to addressing these risks. Lars, great to have you with us. Over to you.
Thank you, James. Thank you for the introduction. Yeah, it's a pleasure to be here as a representative of the University of Liechtenstein in a webinar by the Liechtenstein Initiative. And yes, I will take you on a little detour, as James said, looking into the environmental aspects and then see what we can kind of transfer to the social part or to the FAST initiative specifically. Next slide, please. So, as I said, lessons learned from climate investments, action that can be transferred to FAST. Next slide, please. Okay, and I'm going to start off with this slide, which is kind of zooming out a little bit, and it's probably going to be surprising, shocking, whatever to some of you. And this is not what the IS situation is currently. This is what we believe the situation should look like. So that means if we have on the left side, we have current financial system and we focus on financial returns. Now, we do have different measures, different actions that are out there that trying to incorporate, and that will be the environmental part, climate actions into our financial system. So let's call that sustainable finance, right? Of course, that sustainable finance side, to a large extent, if we're not moving all the way into the philanthropy space, we'll still have financial return that's at the center and that investors will demand. But we will also have an impact side, right? And that impact can be split up into the environmental component and into the social component. And the important part here is that these components, all of them have to be measurable to some extent, in order to really grasp the change that is taking place. So impact is change, right? It's real economic change that's taking place that investors are trying to influence. And as far as I'm concerned, if we're talking about sustainable finance, all of the products should have that impact component in there in order to make sustainable finance worth the while and worth the time. Because otherwise, as we have it now, when we talk about sustainable finance and impact, we're generally talking about impact investing as one niche of the overall space. As far as I'm concerned, sustainable finance can only be differentiable from traditional finance and also add value if that impact component relates to all the products within that space. Next slide, please. And if we talk about the similarities and differences between the environmental and the social space, one thing that is striking to both of them is that the risk, to a large extent, yet not limited, but to a large extent can be reduced to certain industries, to certain sectors. So if we talk about climate risk, we talk about energy, we talk about real estate, transportation, materials, and on human trafficking sides, and we've seen the slide earlier by James, we'll talk about personal services, domestic care, construction property, mining, food and beverages. So the risks are concentrated to some extent towards certain sectors. But what they both have in common is that the financing for businesses who act and engage in these sectors takes place by financial institutions. That could be banks, asset owners, asset managers in private and in public markets. Now, given the fact that these risks are concentrated to certain industries, paved the way to one way of dealing with the problem, and that is excluding them from our portfolio, right? So the most simplest form is an exclusion or a negative screening, saying these industries contain a lot of these risks, so I don't want to have them in my portfolio. But that doesn't solve the actual problem. It just deletes it from my kind of investment space. So next slide, please. So what we have to look at is, and I'm trying to sum it up a little bit here, is that we have different players, right? We have on the left side, we have the asset owners and the asset managers. We have the real economy, and we have on the right side our environment and the society as such. And there are direct influence and direct channels and indirect channels. And the one I want to focus on right now is the indirect channel, where investments are influencing the real economy, hoping that this impact generated, this financial investor-driven impact, actually translates and leads into a direct impact in form of real economy changing towards a more positive outlook. And what I want to do is give a short overview, focus on this one channel that is kind of this asset manager to real economy channel here. And what are basically the tools of how impact can be translated, and what are the kind of actions that can be taken. So next slide, please. So this basically wraps it up a little bit. And what it indicates is, and this goes back to a bit of, if we look at the current literature and the discussion that is going on, what is actually, where do we find that this is primarily related to climate impact, but I believe that can be to a large extent be translated to social impact. Where do we actually find positive evidence of impact-driven actions, and where is the result? Mixed would be yellow, green would be there is impact, and red would be, well, maybe not so much. And what we can see in the literature at the moment is that indeed, while screening and negative screening and exclusion, as I mentioned before, seems to be a very obvious and simple solution, it doesn't actually have that kind of impact that we would like to see, right? Because this only happens, and that's what we have to be clear of, if as long as there are other market participants in the market, and this is primarily the case in the secondary market, of course, who are still willing to buy these companies that we are excluding from the list, then it's just going to be a shift of ownership, but no actual change taking place. So essentially, the costs of the exclusion that investors engage in have to be higher than the costs of the business transforming in a more environmentally and socially friendly way, right? Otherwise, it's not going to take place. The second component is ESG integration. ESG integration is an interesting case because I think, as I said, measurability is important. So ESG information play an important role. The problem here is that it's very heterogeneous in its application. So even if the information themselves can be material, we first have to identify materiality for certain businesses and sectors. And then we have to translate this materiality in our investment decision-making so that actual impact will emerge. So again, there is a case to find impact there. However, the heterogeneity makes it difficult. In the secondary market, active ownership, like engagement, seems to be a very direct mechanism of how investors can have influence on the business. However, that again is limited to a certain size of investors, because not every investor will have the opportunity to engage. Direct investments, I believe, is and the evidence shows, is a very good channel, both private equity, venture capital, and also private debt, to really drive impact. And I think a nice way of differentiating between the secondary market and direct investments or private markets in this respect is that secondary markets are actually financing change. That means investing businesses have to adapt their existing business model in order to become more friendly towards the environment and social issues. Whereas direct investments actually at a very early stage have the opportunity to finance innovation and to finance new business models that are in an environmental space, net zero businesses, right? But also in a social space that really tackle the actual problems rather to reducing the exposure as in the secondary market space. So I think the private market space is a very interesting market to really get impact. I'm going to jump to the last column, which is politics. Final remarks on that. I think politics is also an important aspect. And politics, there is a direct channel, association channel, and initiatives. Direct channel is clear. Businesses themselves can have engage with politics, make clear statements on what they believe are right actions to take and how business models should adapt. Associations as their interest representatives basically also have a voice. And what companies have to look out for is that the voices and the statements that the associations make actually align with the beliefs of the businesses themselves, right? Otherwise, we get a conflict of interest where the business say, well, actually, we believe that climate action has to be taken, social action has to be taken, modern slavery has to be completely erased. But maybe some of the associations have a take on it that might differ from my personal business. So again, that is something that is very important to assure. And I think if we sum it up, the environmental part and the social part and fast in this respect is that, and this was mentioned before, to a large extent, it becomes a supply chain case. So in the environmental space, we're talking about scope 3, which is we should incorporate the whole supply chain when we evaluate the environmental impact that a business has. And that's the same thing from a social side. Well, if I as a business outsource part of my my supply chain to countries where I believe I can have lower costs to produce that material, still that has to be incorporated into my identity as a business, and therefore the whole supply chain has to be represented here. So I guess in both cases, that's a really important stage. So yes, there can be impact from investments, but it has to be very focused, and there's no easy solution, I would say, right? The cheap shots of simple actions are probably not going to be the most effective ones in realizing actual change. Thank you.
Thanks, Eric. So much to dig into there. Lots of great teasers for us to come back to in the Q&A. One question, since I put Shalini on the spot, I want to follow up with one small question to you now, Lars. We have a very mixed audience. There are some people for whom this question will be really, Finance 101. But you referred, for others who are newer to this area, could you just explain what you mean when you say, when you talk about materiality? This is an important concept in the space. You mentioned it. Can you give us just a nutshell explanation?
Sure. So basically, materiality refers to the fact that not all extra financial information matter in the same way to every business and to every sector. That means if we talk about ESG information, environmental, social, and governance information, those have underlying KPIs that can go up to, let's say, 400 different KPIs. And not all of these KPIs will have an impact or will have an influence on every business model that is out there. So what I have to do as an investor, and ideally as a company myself as well, is identify those aspects that are crucial to my business model, and therefore really focus my actions to improving these specific aspects that are of relevance. Because to make changes to ESG aspects that are not material or do not actually matter for my business model, then they will also not create any impact or any change. So that's materiality, a very focused concentration on aspects that matter to my business.
Great, thanks so much. And James, can we actually go back one slide? I want to go back, that's the one, perfect. Lars, I'm going to ask you a question now for you to think about, and we'll come back to for you and others to respond to in the Q&A. I want to go back to that really important point that Eric made right at the top, that in this whole space, what we're about is thinking about not just risk to business and risk exposure, which connects back to this idea of materiality, but risk to people. Now, when we think about, for example, whether to invest or even to divest from a particular, let's say, stock, one of the challenges here is if we divest, it's possible that withdrawing our investment might actually increase the risk to people. So it might reduce my particular risk exposure, but it might increase their risk exposure because suddenly, for example, they've lost their job because there's no financing for the company anymore, and they're more vulnerable to trafficking. So the question to you, Lars, is if we think about it from that perspective, how does that help us, for example, differentiate between that secondary market and direct investments, or indeed any of these other factors that you've drawn our attention to? How should we, in thinking about how to mobilize investors to take action on risk to people, what does that tell us about the different approach we should take to these different channels for action? So leave that with you. We'll come back to that and to the whole panel on that point later on. But now I want to pick up on something else you were touching on, Lars, which is about the real importance for this whole area of effective metrics and of being able to measure, having reliable information that's comparable comparable and relevant and reliable across all of these different investment opportunities. If we're asking, as I said at the beginning, if we're asking capital markets to price in these impacts, then we need to give them access to that reliable information and to be clear about our expectations on impacts, or it simply won't be possible for them to digest this into their business models. So I'm really pleased that we're joined tonight, my time, today for most of you, by Professor Joanne Bauer, who has been leading some very important work grappling with just these questions in this space. Joanne, wonderful to have you with us. Thanks so much for making the time. Over to you to explain what you've been doing.
Thank you so much, and thanks for inviting me to be part of such an important conversation. Your reference earlier to the US made me think that I might be having to do a lot of heavy lifting over here. I can say that we are kind of breathing a collective sigh of post-election relief, although when it comes to modern slavery, even this administration has been making some progress. So perhaps we can talk about that a little bit more. Next slide, please. I'm going to be talking about work that my organization, a new organization I co-founded 2 years ago, Rights CoLab, is engaged in to help improve the SASB standards in relation to modern slavery. And I might note that we're very grateful to the support of the Moving the Market initiative of the Freedom Fund, Humanity United, and UBS Optimist Foundation for this work. Next slide, please. Now, many of the participants in this webinar will already know that the SASB standards, which were first published in November 2019, are a set of financially material ESG standards that are backed by the world's largest institutional investors. The SASB standards are a response to the peculiarities of US securities law that does not require ESG disclosure unless it is deemed financially material, with the decision of who and how it is deemed financial material up to the reasonable investor. So the SASB standards are based on research conducted around 2011 to 2015, and that's significant. I'll talk about that in a minute. That determined the standards that have financial impact and demonstrate investor interest specific to 77 industries. And they were created to fill specifically to fill that gap. In other words, SASB extends fiduciary duty of care to ESG obligations and also compels companies to disclose against it. And in this way, at least in the US context, it is more powerful than other ESG standards. And I'm going to pause and note that there is a kind of perversity, and something I've been conscious of throughout this project, of this notion that there needs to be a financial benefit to me as an investor or my beneficiaries in order for me to care about the degrading, abusive way in which you are being treated. But we live in the world we live in, and there's an opportunity to work within the system to improve lives, right this market failure, and this project is an effort to do so. So 2020 has really been a banner year for the standards. It began with BlackRock's letter to issuers in January stating that they require reporting to the SASB standards as well as to the Task Force on Climate-Related Financial Disclosures. And BlackRock signaled that a failure to do so would result or could result in a vote against management on shareholder resolutions and against directors if companies did not progress. And then 2 weeks later, this was followed by a similar message from State Street CEO. The SASB standards also passed a shareholder resolution test stood up by the shareholder advocacy organization As You Sow, together with my Rights Collab colleague Paul Risman, who filed a series of resolutions at companies using explicit SASB language to demand specific disclosure according to SASB. And of the 4 resolutions that came to a vote, 3 received majority support, and the 4th, at a company called Sanderson Farms, ended in a negotiation with the largest shareholder, whereby the company, in the end, agreed to publish a full SASB report. So in a way, it was a 4 out of 4 win for those resolutions. Now today, there are about 357 companies that are reporting against SASB. That's in less than 2 years. And because of those letters, the BlackRock and State Street letters, Vanguard also similarly signaled that they wanted portfolio companies to report according to SASB. We're expecting a lot more SASB disclosures next year, that there will be a significant uptick. Next slide, please. So this is actually a slide that SASB has put together just to give you a sense of who is on the investor advisory group. So you see the major asset management firms, State Street, BlackRock, Vanguard, Fidelity, and others. Next slide, please. This is also a SASB slide indicating the timeline in which SASB was developed. And you'll see that the research for standard setting started in about 2012 and was completed around 2015 or so. And I want to put a pin in that point, both because to think about what the state of research was at that time and what the state of evidence of financial materiality was. Because the reason that we're working on this project and our theory of change rests on the notion of dynamic materiality. The idea that materiality is not a static concept, but evolves over time and is evolving. And then you'll also see all the way to the right that SASB has also noted the significance of BlackRock and State Street's request of companies to report against the standard. Next slide, please. We've already talked, and James referred to the importance that the asset managers are placing on ESG investing, such as this report by the BlackRock Investment Institute, in which they stated that evidence suggests that focusing on ESG may pay the greatest dividends in emerging markets, and that issues such as natural resource management and labor relations can be important performance differentiators. So next slide, please. So from our perspective at Rights Collab, and I should say we are a nonprofit seeking to advance human rights across the fields of business, finance, technology, and civil society, we saw an opportunity here. and an opportunity in particular to address an issue like modern slavery. And the opportunity comes from the fact that that investor interest in ESG topics has grown exponentially since SASB completed its research in 2015, 2016, as has evidence of financial impact of ESG topics, and that the twin indicators of financial impact and investor interest are how SASB defines financial materiality, and that is the standard for establishing the 77 industry standards. And this change is especially true for social topics, because an interest in environmental standards has been more longstanding, but the social topics is actually where we're seeing a lot of change. We see a significant growth in the volume and quality of data that can be applied to both investor interest and financial impact. Methods of data science analysis have advanced significantly. At the time of SASB's research, techniques of machine learning and natural language processing were really just in their infancy. And most of their research was done manually. So today, we have the means to refine that research. And SASB is quite aware that the standards require updating. I think even when they were published, there was a plan that they would be updated. And in September 2019, a little over a year ago, the SASB board made a decision that they would update the standards on a project-by-project basis. And the first project they launched was the Human Capital Management Project. And that is precisely because there was so much pressure for investors to improve on human capital management. And I should add that there are now 10 projects, but again, the Human Capital Management Project was its first. And then it's important to note that SASB is working to globalize these standards. While it was originally, again, a response to, and a specifically sort of US standard, very much now SASB is approaching standard setting on a global basis, and it's in the process of revising its conceptual framework to communicate the global nature of the concept of financial materiality. This is, of course, also very much influenced by the Non-Financial Reporting Directive and all other developments within Europe. So next slide, please. So in response to all this, we've built a project to contribute to SASB's Human Capital Management Project by enhancing the standards with respect to modern slavery and associated labor risks. And this project has 3 components. The first is a data science component. We have also convened a group of labor experts to provide subject matter expertise to the data science project, and civil society engagement to communicate our findings to civil society and all stakeholders broadly. For all of this, we're in close, regular contact with SASB's research team to align our work with that project, both in terms of the timeline and also just to be sure that we can bring information to bear on that project in a timely manner. Next slide, please. Our data science component is carried out in collaboration with the Data Science Institute at Columbia University in their Data for Good program, which recruits graduate and undergraduate students trained in data science, especially natural language processing, together with a supervisor to work on these projects. And this is an image of the blurb about our project on the recruitment page. Next slide, please. So the first thing we did in this project is a needs assessment. What exactly did we need to update? And we identified 2 types of problems, or at least areas in need of improvement. And the first were these illogical gaps in SASB's materiality map. And it might be easiest actually if we move on to the next slide, so I can explain this. This is an image of part of an expanded SASB materiality map. And I've circled there the labor practices general issue category, where you can see that for some of some industries, labor practices are deemed to be material, but for many others, including apparel and footwear, appliance and manufacturing, and so forth, were not deemed to be material. So those currently, if you're in one of those industries, you don't need to report against labor practices. So let's go back to the previous slide, please. So I can give you another example specifically related to modern slavery that in the supply chain general issue category for iron and steel producers, the following standard exists. Discussion of the process for managing iron ore and/or coking coal sourcing risks arising from environmental and social issues. So this standard may have evolved at the time from reports that US steel producers were importing pig iron from Brazil produced with forced labor, but the standard doesn't appear on the materiality map for a lot of other industries that may import materials produced with forced labor, such as construction materials, fuel cells, industrial batteries, and so forth. In fact, it's missing for many of the goods that are listed in the US Department of Labor's list of goods produced by child labor or forced labor. Similarly, in the food and beverage sector, there are supply chain standards for every industry except tobacco, even though the US Department of Labor has cited forced or child labor in tobacco supply chains in 16 countries. So aware of this gap, SASB currently, one of those 10 projects I referred to earlier, SASB has a project studying whether supply chain standards should be extended to cover the tobacco industry. So recognizing this gap, our first data science project is what we're calling the extension project. It's to extend topics to other industries and fill in those white spaces that you saw on the materiality map.
Joanne, 2 minutes, please.
Sure, and I'll go very quickly. The other problem is one of weak metrics, and what we see in many of the metrics, particularly for supply chains, is that they're relying on third-party certification and social auditing. For example, in the apparel sector, there's a metric to report on the percentage of tier 1 supplier facilities and supplier facilities beyond tier 1 that have been audited to a labor code of conduct, and the percentage of total audits conducted by a third-party auditor. But labor experts have long noted that social audits and certifications, which can be, or systems that can be gained, do not adequately capture corporate performance, and that what we really need is more precise indicators that demonstrate effective due diligence. And for this, we have created an addition project. I'm going to stop here, and in the Q&A, if you're interested, I can talk some more about how the specific methodologies for those projects and some of the other metrics that we're looking at. All of this is also available on our website at www.rightscollab.org. And I'll stop right there.
Wonderful. Thanks so much, Joanne. And thanks also for that helpful segue to the reminder about Q&A. So now is the time, everyone who is watching, to get your questions into the Q&A box. It's just down there on the command bar at the bottom of your screen, your Zoom screen. Just click on Q&A and send us your questions in that box. We'll be happy to collect those and bring the panelists in. We're going to have plenty of time, thanks to their great discipline on time, for Q&A. And fair warning to the panelists, I'm going to ask you questions, as we heard, about divestment. How do we approach divestment and asset selection, investment selection? How do we look at that through a risk to people lens rather than a risk to business lens? I'm also going to come back and ask you a question about the political climate around these issues in different places. We have very different trajectories right now in Europe, in the US, and arguably in Asia. So I'd love to hear your thoughts. I'll reframe the question when we get there, but just fair warning. There will be others. I see questions coming in now from people in the Q&A box. Please keep firing away. We'll gather those up. But before we get to that, it's great to have with us one final expert speaker, Dr. Prabhu Thirupathy. Prabhu is building a really fascinating instrument in India that looks to address modern slavery as commercial, looks to the opportunity to address modern slavery as a commercial opportunity. And I'll let Prabhu explain how that works. Over to you, Prabhu.
Thanks, James. And hi, everyone. Before I go into the instrument, I thought I should speak about something interesting as I was sitting for this panel. So I'm sitting facing my balcony. And I wish you could see it, but today is the eve of Diwali, the biggest festival in India. So if you look out my balcony, there are lights all over our neighbors. The entire country is lit up. And Diwali is essentially the festival about the eradication of slavery. So there are 3 separate origin stories about demon kings enslaving humanity and one particular god taking 3 different avatars and destroying this demon god, thereby liberating humanity. And we are celebrated every year by lighting these oil lamps and welcoming God and essentially saying bye-bye to slavery. All this is to say that one, slavery is as old as humanity, and we need newer ways to tackle it. Second, it is very persistent, and we need multi-pronged and repeated attempts, as it took 3 attempts for a god. And lastly, today and now is as good a time as ever to kickstart this effort. Happy Diwali to anyone watching from India, and to everyone else as well. We could go ahead. Speaking about this instrument per se, we are very excited about it. And before that, congrats, Shalini, to what you've accomplished. And it was great hearing the numbers. Ours is going to be much smaller, but I think small steps in the right direction. Starting off with the problem, India, of course, has the biggest, modern slavery burden in the world. And we have had multiple attempts to tackle it. Still, we see that about 3 to 5 million vulnerable rural Indians fall into forced labor every year. In the Indian labor market works in such a way that labor originates from rural India and from the hinterlands and ends up in the cities to do odd jobs, construction labor, other labor for a big part of the year before going back. And because of this complex web, they do not have a home when they come over to the cities to work. They live in different conditions. If they have a healthcare catastrophe, they have nowhere to go but reach out to completely alien sources. So every year, the problem of modern slavery happens. And this is particularly high in the place of construction sector. This is the biggest employer of labor in India, and quite evidently so, the biggest source of modern slavery as well. On the right, you would see a big pyramid. That essentially is what the Indian construction sector looks like. You would have the financiers coming from abroad as well as India financing developers, who in turn put out job orders to large contractors, who then turn around and give it to subcontractors. And then it moves to that crucial step of micro contractors before you reach the workers. So these micro contractors are essentially people who employ about 5 to 20 laborers under them. And they run these job orders, be it plumbing or any kind of work at a construction site. And that is a crucial part we are looking to tackle. And they essentially employ about 90% of all of the construction labor in India. And that's what makes us very much important. And going back to what Joanne said, we really are looking to have a very sharp focus on, say, capitalism. It's time for, say, ancient gods to save us, but we are moving on to, say, the modern gods of capitalism and following the trail of money to see how we could make capitalism and work in order to tackle modern slavery. And we are essentially looking at prevention of modern slavery than essentially taking people out of modern slavery. And before we move on to the next page, I want to just make a note that as much as we are looking at a blended finance mechanism and newer financial instruments to tackle this, there is still a place for other instruments as part of this toolkit. And there will remain a place for them in the coming decades as we look to tackle this problem. Could we move on to the next slide? Specifically speaking about our program, like I said, we are looking to focus on this thin sliver of modern micro contractors who form the crucial link in this entire value chain. And given they employ these laborers, and if these laborers, that is primarily because these micro contractors do not pay on time. And just going back to the pyramid that you saw in the last page, the job orders flow that way, and the money as well flows that way, which means the payment needs to happen in steps, month on month, week on week, and until the micro contractor has done his job, he doesn't get a payment. However, the laborers need to be paid week on week and month on month, and that creates a problem in working capital for the micro contractors, which is where, all of these financial catastrophes come in. So we are looking to tackle this entire problem through 4 parts. One is low cost working capital, so that the micro contractor doesn't have to wait until his job is done before getting payment from the top of the pyramid and then paying his employees. He could pay them based on their activity and as and when things happen, and not be prey to these working capital delays. The second is we are looking to provide them a steady stream of work orders from reliable contractors that will help them keep up their business on an ongoing basis. Third is entrepreneurship training. As much as we spoke about, say, following the trail of money, financial incentives, we do note that there is a big gap with quite a few of these, micro contractors about entrepreneurship and managing people essentially. How do I manage a book of records? How do I balance my books? How do I ensure my cash flows, which are incoming, are relevant and related to my outflows? So essentially, we are looking at helping train them on that. And the fourth is bringing ethically sourced workers as well, ensuring that they are not part of, say, rings or chains where these workers and their families are already part of, say, a modern slavery network or ring from their villages all the way up. So those are the 4 big levers we are looking to do. As far as industry engagement is concerned, we recognize that you cannot solve this problem just by looking at micro contractors. The industry is a very key part of this problem. Engaging the financiers and the industry is going to be key when we solve this. And from our conversations, we've seen a lot of interest from the industry, the construction industry and the financiers in India. We are essentially looking for 2 things here. One is for them to provide us site access, which many have readily agreed to. The second is, as we go back and give it to them, ethical procurement of these laborers. So essentially, after 1 year of providing site access, they could be sure that all of the laborers in their sites were ethically sourced and are working through ethical means. That essentially is what we're looking to do. Moving forward to the next page. A quick, schematic of the facility. I wanted to spend a bit of time here to explain how all of this works and how the trail of money, or how the money flows, and how it's related to, this entire problem of modern slavery. On the left, you'll see what typically happens with these micro contractors. Like I said, a working capital debt, the contractor or the financier doesn't pay them, the developer doesn't pay them. They go out and borrow this money from informal sources. It could be a local money lender, or it could be, say, a loan shark, but they essentially get it at 40 to 120% per annum. And this once again goes back to entrepreneurship, where these are first-time entrepreneurs. They want to make a mark in their job, but they haven't already mastered financial accounting and what to do with the money. So they go ahead, take a loan, and that essentially puts them in a debt trap and forces the laborers under them as well down the same path. What we're looking to do is provide them a more ethical and cleaner form of capital. On the top, you would see investors who essentially provide money, which is pooled into a working capital facility. Second, from the right, you would see credit guarantees, because it's a completely new mechanism. There is no, in the status quo, there is no precedent for such an instrument. So what is the risk? What is the return? Nobody knows. So there are credit guarantors who are looking to guarantee this amount to 50%. And thankfully, we have 2 of the biggest donors in the space already committing 40% of capital. And then this money would be lent out through an NBFC, which we already roped in as well. a market-based NBFC which has social values, which will then turn around and lend to the micro contractors. And then as the work progresses, these micro contractors will get payments from the developers and will be in a position to pay back to the working capital facility. And we are speaking about, say, the lower single digit or capital returns for this facility. And most importantly, number 5 is going to be the monitoring and evaluation. And that's the most important part linking to modern slavery. The monitoring is going to be around whether, like I said, these employees have been sourced ethically, but most importantly, are they being paid A, in full, B, on time every month as they work on these sites. So we are essentially going to use digital means to collect data or request them to let us know whether they have been paid their full wages and whether they've been paid on time, month on month for this. And that essentially will then help this working capital facility or the NBFC to get interest buy downs from donors, because donors want to see impact. We will measure and evaluate and show them that these outcomes around modern slavery have been reached, which in turn will prompt the donors to pay this NBFC and reduce the interest burden on them. So this is essentially the first step in what we are doing. Could we move on to the next page? Next page. We are looking to do this in 2 parts. So right now, what you see is phase 1 of the effort. We are looking to focus on 1,800 workers, and this facility upstream is going to give 3 to 4% returns for investors. So what I'm speaking about is dollar returns for overseas investors who will invest into this credit line for the NBFC, which in turn would turn around and lend to the micro contractors. So we're looking at a minimum ticket size of 200K, a 2-year tenure, and most importantly with the risk minimized because there's already guarantee from some of the most credible donors in the space. And in terms of the impact, like I said, we're looking to focus on 120 micro contractors who are already being corralled in some of the biggest metros in India through credible skilling providers and contractors, through whom we'll look to focus on about 1,800 migrant workers as well. So that's essentially what we are looking to do, and the impact we'll look to create as well. Thankfully, like I said, we've had great interest from some people who are part of this group as well, and have already commitments on guarantees, quite a few commitments on the investor capital as well. And happy to take any questions as we go ahead on how this instrument works and what we are looking to do over the next 2 years. Thank you.
Super. Thanks so much, Prabhu. A lot of exciting innovation happening there. And I know you said at the outset that, this is small compared to, the trillions that Shalini is playing with in that initiative. But I think what's very important is to see this slide here, that there are these kinds of innovations that are looking at the possibility of both assisting people and offering commercial returns. As we see more capital moving into the part of the market that's looking for that impact as well as financial returns, we're going to need proof of concept of these kinds of approaches that can then be scaled up. But that's also a great way into our Q&A session, because I want to start actually, Prabhu, and probably you, Shalini, with a really nice, easy question that we've had come in from anonymous attendee, an amazing name. I thought James Cocaine was an unusual name, but imagine calling your child anonymous attendee. An anonymous attendee asks, I was surprised to hear slavery being approached as a reputational business risk. Is this line of argumentation not missing the point? It suggests that the main motivation to fight slavery is to avoid business risks, i.e. monetary motivation, and not because slavery is principally wrong. Human rights are a goal in itself. Is there not a risk to the whole idea of human rights if we approach it only from such a utilitarian perspective? So Prabhu, since we've just had you talking about the opportunity to, as some people put it, do well while doing good, maybe I'll give you a swing at that first. Come to Shalini, Joanne, Lars, if you want to jump in, fine. I have other things teed up in the queue for you as well coming your way. So let's keep these first rounds of interventions short if we can. Prabhu, your thoughts on this? Do we need to see this as a trade-off or not?
Sure. So I'm just going to pick the business part of this and leave the rest of it to the rights experts in the panel. I think it was a great question and something we ask ourselves. And while all the people in this room are aligned, and in fact, say the investors we speak to as well are aligned, unfortunately, that's they as well are subject to market pressures. Say there have been sporadic attempts by developers to do exactly what we are speaking about, providing ethical contracting and so on. But as long as it's sporadic, they essentially are in the marketplace all alone, seeking probably slightly lower returns because they are being ethical, they are incurring higher cost of M&E, higher cost in sourcing labor and so on, while their competitors continue to do business as usual. So from a purely utilitarian perspective, it definitely is a system level issue and needs to be tackled at a system level and cannot be left to individual businesses. And to your question of say whether there's a reputation / business risk, as long as it is recognized at a systemic level and it is tackled at a broader level, it is going to be difficult to make a case for individual investors or individual developers to do this. So I'd say the reputation risk exists, but I think it will take some more time before that even becomes much bigger. The wave has already started in quite a few forums and areas that we have seen. In terms of the business risk, like I mentioned, unless we make it a business risk, we are not going to transcend a place where this becomes a majority view or this is the status quo.
Great, thanks. Shalini, you've dealt with these issues in your work with institutional investors over many years. What's the perspective from where you sit?
So the perspective there is everyone on a personal level has absolutely knows the devastating impacts of human rights abuse and modern slavery, and there's no doubt that there's an ethical element to that, and that's undeniable. Where it sort of gets tricky is where the shareholder versus stakeholder primacy doctrine that we kind of are living in right at this point, and the perception of what a fiduciary duties are. And I think that is going back again to what Prabhu was talking about at that systemic level, that there is a natural sort of systemic conflict there that kind of can't be addressed by any one investor or any one business. It has to be addressed at a systems level. Certainly in language, when we do talk about reputation and business risk, it's almost like a means to an end for a lot of people in the field who work in this space, I believe. So ultimately, you know, we know that we're all sort of interested in eradicating this modern slavery. But at the same time, we also know that the path to get there and to bring others along on that journey is not necessarily the smoothest if potentially you're flying that particular flag of, this is the right thing to do, and it is absolutely the right thing to do, but it has to be framed in different ways, in different contexts. It's an unfortunate reality, is what I found certainly in the field.
That's certainly a very pragmatic perspective, Shalini. I guess trying to channel the view here from an anonymous attendee, there might be a view taken, and I don't want to turn this into a philosophy seminar, but that people should never be a means to an end. The people should be the end, and the profit should not be the end. But I think you rightly and helpfully pointed us to the fact that gets captured in statutory obligations, particularly around fiduciary duties. And Joanne, I might come to you on that because you also touched on this, but just to frame this a little bit more precisely, I'm actually going to bring in a question we've had in the Q&A chat box. This is from Elko Fiole and is exactly on this point. So Elko says, there's talk of changing fiduciary duties, maybe voluntarily, maybe under economic pressure. It seems, however, that this is not part of binding legal requirements. Do we need a change in this, so in fiduciary duties? And what moral aspects would play into that legal change? So I think Elko's getting at exactly this point. Joanne, you mentioned, you know, your kind of, I don't know if this is putting words in your mouth, but your horror that things had to be framed in terms of the financial materiality and couldn't be understood as being intrinsically valuable in and of themselves. What do you think the direction of travel on this is in the US?
I didn't know we were going to end in the US. Your sentence would be end in the US. But yeah, because I think that we do need to look at the whole question of fiduciary duty. Absolutely. It's a problem. And it does bring us into this kind of narrative that again is a sort of perverse narrative that I can only care about this issue of your condition if I can profit from it because I have a fiduciary duty to do so. So I see that as and I'm a little bit dodging the question about how we actually go about doing that, because I think it is a larger endeavor, probably for another webinar. There are people who are starting to work on this question. But sort of in terms of what we've been talking about here, I think it's important to, again, as I mentioned in my remarks, I see hope in this notion of dynamic materiality. And so while I agree that this is a systemic issue in the sense that particularly our problem in labor supply chains is this race to the bottom, it also is an individual company issue and increasingly becoming a risk to those companies, and we need to capitalize on those moments. So we have in the US, the Customs and Border Patrol can now issue withhold release orders for goods that are imported with modern slavery. That if you can't get your goods into the United States, that's a clear financial risk. And we are definitely using that in our project to say things have changed. The very fact that SASB, again, is needing to be looking to Europe, where there's a kind of a different standard because its companies are invested globally, and it's a global standard, is pushing SASB. There's a greater opportunity to push this notion of what is fiduciary duty, what is materiality. And so I think that that's the space in which we're unfortunately forced to kind of work in at this point.
Thanks for raising the withhold release orders too, Joanne. That actually gives us a chance to work in another question from Shannon Stewart at the Global Fund. Shannon says, a couple of speakers have alluded to modern slavery legislation like the Australian Modern Slavery Act. Does anybody have an opinion on how its impact compares to more sharp-elbowed punitive legislation like the Global Magnitsky Act, with personal sanctions against human rights violators and their companies, and Section 307 of the US Tariff Act of 1930, prohibiting the importation of goods made with forced labor? That's the provision that underpins those withhold release orders. So it's obviously hard to assess the impact of the Australian Modern Slavery Act at this point. We haven't even hit first reports yet. But I think what this points to is the fact that we are seeing, as Shannon puts it, some pretty pointy, sharp-elbowed enforcement measures now emerging, which, as you said, Joanne, are going to hit questions of financial materiality. But what I want to ask the panel, and maybe come back to you, Joanne, and then come to Lars and Eric on this, is there not a risk here that actually these issues are becoming geopolitical footballs? So in the US, we see these pointy, sharp-elbowed approaches. We haven't mentioned Xinjiang, but 4 different US agencies have issued guidance specifically calling attention to the role of the investment and financial community in value chains that may be connected to alleged forced labor at large scale in Xinjiang and outside Xinjiang using Xinjiang forced labor. There's a real potential here for forced labor issues to become an aspect of trade wars, frankly, and of geostrategic rivalry between the US, the EU, not only China, but other Asian powers. You know, Lars, you mentioned in your columns that we needed to think about the politics of this. How should we understand these political dynamics? Is there a risk here, Joanne, that we're going to end up actually with competing normative regimes rather than harmonized regimes? And if that's the possibility, what does it mean for the investor trying to figure out how to navigate all of this? Over to you, Joanne.
That's a great question, and I'm actually looking forward to hearing what the other panelists have to say about that. That's certainly, I hear what you're saying. It's certainly not the sort of the sense that I'm getting of what's going on in the modern slavery space in particular. There has been conversation about, precisely because of the Australian Modern Slavery Act and the UK Modern Slavery Act and the California supply chains, which are very different. There's a demand and a need for there to be coherence across those so that to facilitate company reporting. SASB is, as many of you know, is now in a partnership with the GRI and the Integrated Reporting Initiative and several other initiatives to create coherence across standards, again, built on this notion of dynamic materiality, which I think is so important, so that there's a coherence across standards. Now, that doesn't really answer your question because that's still US, Europe standards, but this is the bulk of the market that is saying we need coherence in these standards, and 2020 has again been a banner year for moving forward in that direction. So I'm actually quite optimistic, again, within this framework that we're operating in of fiduciary duty as it stands now. I think we've made tremendous progress, and we're going to be continuing to do so. That's
an optimistic view. Great. I'm going to come to Lars and then Eric to learn from maybe the climate and child labor space on this. Lars, in the environmental space, it hasn't always necessarily been such smooth sailing. We have seen pushback from some countries on investor-driven and lead firm-driven sustainability certification standards. I'm thinking, for example, of the palm oil space, where the RSPO, the Roundtable for Sustainable Palm Oil, has met resistance from Asian suppliers who've created their own national certification systems. Does global capital ultimately demand one harmonized normative framework for measuring these kinds of externalized impacts? Or, is there a real risk? Is the lesson from climate that there's actually a real risk of these things becoming geopolitical footballs? What would you say?
I think there are 2 points from my perspective. The first one is I do believe that it needs a harmonized system. Otherwise, you get a situation where you have something like country shopping or regional shopping or whatever, where companies, individuals start looking for the system with the lowest standards to, if in that way, maximize profits by exploiting people, right? So the harmonized standard is really important to avoid that situation of kind of moving between different places. But it's going to be difficult. Is it realistic? Not sure, but I think it's more realistic for the slavery and human trafficking aspect than it is for the environmental aspect. Now, you mentioned that for the environmental part, there is much more room for disagreement, right? So someone can still have or show or look himself in the mirror if he says, well, I don't believe in global warming for whatever reason, because I found some kind of researcher who said that actually you can interpret the data in a different way. Now, that's possible. I don't think anyone out there in the political space, in any office, would stand up and say, I think slavery, human trafficking is fine. So I do think there's a big difference, which allows actually the kind of human trafficking and slavery side to progress much faster and actually to find one unanimous agreement on how to deal with it much easier than it is in the environmental space.
Eric, can I bring you in on that? I'm hoping I might strike a seam of controversy here. We don't want you all in violent agreement. I think there are probably plenty of countries that say child labor is fine, or at least is more acceptable under certain circumstances and more useful and necessary given our cultural mores and our economic development situation than maybe you in the global capital north might say. Can we learn anything from the child labor space here about the likely dynamics of these regulatory processes?
Well, no, thank you. I think actually the child labor space is probably even more well regulated in a sense that we have international norms back from the 70s in a sense that we're still applying today. And so although there is some variation in terms of the acceptance of certain forms of child labor, perhaps, I don't think that's a legal acceptance. That's you sometimes hear this sort of defensive culture, but typically not from governments. So in the government space, this is probably pretty clear, and the international norms are clear, and there's excellent scope for harmonization here. You would have varying degrees of child labor, but I think as I said in my presentation, child labor is a system failure it's a manifestation of a system failure at a bigger level. So you would have inequalities, for example, economic downturns, poverty, etc. That's why you have child labor. The legal acceptance for child labor, I think, is close to zero from anyone. So I'm afraid I'm not going to be able to give you your controversy there. But in a sense, I think you look at the actions of countries when it comes to addressing child labor. It seems to be down a lot to the means they have to address the root causes again. You see some action by sort of east to west or north to south to influence certain industries. We have, for example, the fisheries industry in Southeast Asia around forced labor, and it provides a push to all the actors involved to address the issues. But these are difficult issues to address, and they do take a little bit of time. I would just mention this in a sense of, if we look at again, taking the perspective of the people affected as opposed to the business side, addressing child labor means addressing these root causes. It does not mean stop sourcing from countries that have child labor. That doesn't help anyone, at least not the children. So they will just probably end up in more precarious employment because they don't actually have a choice. There's no alternative. So this is, again, the question of should you move away from countries that have child labor to manage your own risk? I can't answer that from the perspective of an investor, but you should definitely be aware of it and try to leverage your power to engage with the root causes of this, because that's the only way that people will be better off.
Great, Eric. A lot for us to digest there. I want to actually stick with you and pivot to something else that will make us all better off, and that's simply mentioning the name George Clooney. See, we all feel better immediately. And Joanne Alesi, I'm not sure if I pronounced your name correctly, Joanne, but Joanne's been waiting almost an hour and a half for us to talk about George Clooney. In fact, she's so keen for us to talk about George Clooney that she has asked the question twice. So you see, we got there, Joanne. So this is a question to you, Eric. It's about George and Nespresso and child labor in the coffee value chain. But I want to connect it to a question that the wonderfully named Helmut Sachs has asked, which is really about who is responsible for monitoring this stuff. How do we ensure that, that companies and that investors that are committing to these standards, that governments that are committing to these standards are actually living up to them? In the climate space, Lars, we hear about greenwashing. In the sustainable development space, I've even heard people starting to talk about rainbow washing. You've probably all seen, oh, I've got it on actually, I can show you. Probably all seen the SDG logo with the rainbow colors. So people are now talking about rainbow washing. it's really, there's a real danger here that that companies, investors just cloak themselves in this mantle to get the upsides without actually having to take on the compliance costs and efforts. Is bringing it back to George, as we must, is there a risk, or can we learn from lessons like the coffee and cocoa value chain and how companies have approached child labor there, Eric, about what needs to be in place to ensure accountability with these commitments?
Just taking note, there's a lot in there. So the George Clooney case, I have to say, I saw the question, I had to Google it because it wasn't something I had seen in the media. But
sure, that's your excuse for Googling George Clooney during the webinar, Eric. We don't really need an excuse, it's fine.
No, so apparently this has to do with the child labor in Guatemala. Now, let me start by taking that as an opportunity to talk about how can you find out whether there's risk, right? Because this seems to be the case at hand in a sense here. I don't know enough about Nespresso and how they source, but generally speaking, if you want to find out what the risks are in a country where you're sourcing from, there are plenty of sources of information here. If you're looking at child rights specifically, UNICEF even has a product called the Child Rights and Business Atlas that has indicators for all child rights risks by country. But this is the business of civil society, of the United Nations, etc., to produce this kind of data and this kind of information that investors can use, that companies can use, etc. I had to have a look specifically at the coffee in Guatemala, and the first thing that popped up on Google was a Verite report from 2016, 100 pages about labor risks in coffee in Guatemala. So you can find the information. Now the question is as somebody who goes in and sources from that market, then you see there's a heightened risk of child labor. That's around. What do you do? And I think this is exactly where you need to start. You need to understand what's going on. You need to understand what's going on in your specific, a little bit like you alluded to earlier, James, in your the specific place where you're sourcing from. And then you need to put in measures in place to start addressing this. We see a lot of companies that before they go in and start producing, they would enter into the country in some form a year before, piloting things, etc., to see how can I reduce this risk. Are there ways for me to reduce my risk before I set up shop here? And it can happen. Of course, these are larger companies, but still. So I think, and again, partner with those that are on the ground, that know the situation and that know the problems. So how do I pivot that to your next question? So lessons learned from
yeah, Eric, let me bring Prabhu in there, because I hear what you're saying. And Prabhu, in your particular instrument, for example, I think you have third-party evaluation. Is that right, of social impact?
Correct. Yeah.
So I guess the question that leads to is this scalable? If we're going to have impact at scale, we're going to be bringing in large amounts of investment into multiple efforts, multiple work sites. Is it really scalable to rely on third-party social monitoring, civil society, and so forth to verify this? Or is there simply a risk of that capacity getting overwhelmed by the demand for, let's call them anti-slavery bonds, for example?
Yeah. I think great question, and two parts to this answer. One is, yes, we have a third-party evaluation mechanism. As much as we try to make it digital, low cost, it still forms a reasonable part as a percentage of our program. And that is by design, because we are looking at this as more of a transient program, which creates a proof of concept, creates evidence that these interventions A, B, C, in terms of providing the financial means, in terms of providing, say, access to work sites and so on, and skilling and entrepreneurship training actually have an effect. So what we look to do is create an evidence, and the metrics we have are directed towards that. So this is phase one of it. But once we have enacted something like this for the Indian construction sector, the next step is to go forward and create a more, say, systemically accepted set of norms and metrics and standards, because there's no way you could run, say, multiple bonds and multiple instruments with high cost of M&E again and again. What you need is a transition towards more accepted norms and standards. I think having said that, going back to James, your point, you don't want it going down the same impact washing, say, line, where a lot of these standards can be gamed and companies could put it up gloriously on their annual report. It could be great, but you need individuals or corporations to take a stance and really buy into these standards and metrics in order for this to work. It's easier to push it top down. It's much more difficult to enact the change corporation by corporation and get them to actually buy into the process and program.
James, can I jump in here?
Yep, please, Joanne, go ahead.
Just returning to the questioner's question about with respect to whitewashing by investors. And I think it's important to point out, and I actually need to, I need to point this out because my colleague, Paul Rissman, who is a former chief investment officer, would always point this out to me, is that this is where working in the system works, that that there's a fight because investors have a fiduciary duty to look after these issues. They must understand these risks. They're not doing this just simply to whitewash. They need to make sure their returns are not just financial returns, they're risk-adjusted returns. So the question is, how do we make sure that these risks are risks? In other words, perceived as risks. Risk to be, and that's the tougher question. So the clear things like with the withhold release or orders and preventing goods from coming into the borders, the clear issues around that came up with the revision to the trade agreement between US, Canada, and Mexico, which actually will requires the compensation that we're now seeing going on at Top Glove and so forth. Those are financial impacts. So I think the tricky issue is how do we define these as financially material issues? And once they're defined as financially material issues, that question of whitewashing, at least on the investor front, is off the table because it becomes a critically important issue anyway. And that's where you get the moral case and the business case that's sort of perfectly joined.
Great. So we're into the last 5 minutes now. So I'm going to ask everybody to keep their answers really short, but I'm determined to try and get through all the questions we've been asked. So the first one actually is right back at you, Joanne. We have a question from Emmeline Metrard about the role of the European Banking Authority and other European standard setters in addressing this. So let me just kind of slightly tweak that and ask you, apart from SASB and the work you're doing there, what are the other places we should be looking to get that work you just described done, to get these risks enshrined as risks or as risks that need to be disclosed? Where is the game at around the world to make this happen in the next couple of years? If you have thoughts, Joanne.
Yeah, I mean, I think I just have a pretty basic answer, and that I think that some of the really important developments that are going on is in the harmonization of these standards. There's a really concerted, everybody understands that there's a problem with the ESG standards and that there's a multiplicity of standards. There's often been a kind of tension between, at least in the US, between GRI and SASB. Now there's a kind of a harmonization again around this sort of the thread is this notion of dynamic materiality that's cutting across that hopefully will also, is welcome within the EU as well. And we're sort of, again, moving towards this harmonization that I think is critically important. And if that's the case, if I'm right about that, then again, where the focus needs to be is on continuing to identify and make that case for financial materiality so that so that we can continue to see the push and the involvement of these standards to the point where all investors, not just some investors, but all investors can internalize the normative standard that we must eradicate modern slavery from our portfolios and our supply chains.
Great. Lars, you're sitting next to a country that's about to take a big public vote on some of these issues. Switzerland in a couple of weeks will be holding a referendum on corporate risk disclosure relating to some of these issues, human rights and so forth. What do you foresee as the outcome there? And do you think this is more likely to be a national discussion for the foreseeable future, or are we going to go up to the regional level?
I think exactly that point was actually what motivated Elke earlier to ask that question, because I remember in my graduate studies, I had a course with him on governance. So I think the vote is going to be in favor, in the sense of it's going to be incorporated into fiduciary duty, or in German, the Sorgfalts- und Treuhandpflicht. However, I would like to add to that point that Joanne made earlier, which I completely agree, is technically we don't need a separation to specifically specify environmental and social aspects to be included, because as Joanne said, investors have the duty to account for risks, and if this is a risk, then it has to be accounted for. And the question then that Joanne said, whether or not it is a risk or not, well, if efficient capital markets incorporate all available information in determining what a fair price is, then all information means financial and non-financial, extra financial information. So per definition, these aspects have to be included in your fiduciary duty without it explicitly being stated. That's my personal opinion. So I think if you actually take fiduciary duty serious, by now you should have already incorporated it anyway.
Joanne, one last question to you from the Q&A box. Question from Shubha Chandra. Will the recommendations of the Rights Collab be available for public comment before they're submitted to SASB?
Well, absolutely. And I should note also that SASB is about to release its framework, a human capital management framework, which is the first step on standard setting for public comment. And we will be issuing our own public comment on that and hope that it may influence others. I should add that, and there's something I was going to say in my presentation, that human capital management in the SASB framework currently does not include the supply chain management general issue category. That is sitting in something else called business models. We think it's extremely important that the human capital management area includes supply chain, because we don't know, I don't know, how you can possibly judge whether or not a company is a risk or understand the whole company without understanding its supply chain. And so we understand that the preliminary framework will be posing that question around supply chains. And we've been building a case, and we have this on our website, for why supply chains need to be part of the Human Capital Management Project and part of that framework. And so this is kind of a pitch that I hope that others will respond to the SASB's public comment period. And I hope that you will raise this question as well and support this idea that supply chains needs to be part of the human capital management dimension. But yes, as I mentioned, also civil society engagement with stakeholders is a big part of this project. We will intend to hold webinars and get feedback, and as we are also interfacing with SASB, and welcome everybody's engagement on that.
Well, thanks for bringing us to that point, Joanne. I think that's a great note on which to leave. Clearly, there's a lot going on in this field. We've heard from our panelists all the wonderful different things that are happening, but also a real need for active engagement to shape the standards and the regulatory frameworks to encourage capital to address these risks appropriately. So on that note, I'd like to ask you to join me in thanking our wonderful panelists, Prabhu, Joanne, Shalini, Eric, and Lars, for their insights. Thank you to all of you for being with us and your active engagement today. Please do visit the FAST Initiative at fastinitiative.org to learn more, and we'll look forward to seeing you again on an upcoming webinar. Thank you very much. Stay safe.